Hello and welcome to Chapter 5 Homework. I'm going to go ahead and go over these and see how well we can do buyer and seller with merchandise transactions and probably having a multi-income statement. So starting off first, we're going to go ahead and just go through these problems as they go. And again, remember, I will not repeat any items that we've already discussed. So, without further ado, first problem, again, you're going to have an invoice. So here's our fancy dandy invoice that tells us all the information that we need. Now, I like how they kind of have it scanned and then they retyped over it. That's always funny. And they could at least formatted the numbers a little bit better. Anyway, so first thing that we're going to end up doing, let me minimize that. We're going to journalize the transaction required by Rocker Tires on September 23rd. And assume tires are purchased on account. Okay. So they are using the perpetual system and they're receiving the following invoice. So they are the buyer. Sweet. So again, with the buyer, it's a little bit easier. Because first off, they're always going to receive merchandise inventory. It's going to be for the total amount, which is 956.16. Here, they actually have a discount at 1 for 10. So, this is if they do the discount. Remember, only the seller, we will calculate it with the discount. For us, we always do at cost for the buyer. And of course, the credit, since this is purchased on account, is accounts payable. We'll go ahead and close that out. Okay. There we go. We'll check. And of course, gotta always remember the explanation. There we go. Okay. Second one is journalize the return on Walker's books on September 28th of the D39X4 radicals, which happens to be ordered by mistake. Okay. So let's check the invoice. Let's find those radicals. And those happen to be 187.25 cents. So again, when we do a return with the buyer, it's pretty much just a flip of this account. They no longer owe that amount because they're returning it. So the accounts payable has to be debit. And then they credit merchandise inventory because they no longer have that inventory. And of course, that'll be it of that. And return inventory to seller. Check answer. Nice work. And now it's time for the payment. Okay. Here we go. First off, we know we have a difference. So always take out the return when it's the buyer. 956.16 minus, let's go here to 187.25. So they still owe about 768.91. So again, let's go check out the discount, which happens to be credit terms 1% discount, 10 days, which we know they're within the discount period because even here tells us the discount due date. So, first thing that we have is, of course, accounts payable. It's going to be debited for the amount that we've calculated, 768.91, because that's the amount that they owe still. and I'm going to have our merchandise inventory and then cash. Okay, so we're going to take this amount, 768.91, and multiply it by 0.1 or 10%. And you always round to cents. Okay, so this is $76.89 for me. So that's my merchandise inventory, $76.81. Then we're subtracted 2 to get our cash. So $692.02. Oop, there we go. And of course, explanation, we paid within the discount period. We are done with that. Now, oh, for some reason I put 1 instead of 9. My bad. Okay, something's off here, because we did the discount correct. %. Oh, my bad. I was so bad on this. It's not 10. 0.01. So this is $7.69. Oi. That tells you a lot. There we go. As you can still see, I'm still stuffed up from when we had class before. So we should be at 761.22. There we go. And that's really it. Just be careful of that, because that's what caught me. Just make sure you convert your percentages to decimals. That was just a bad. Okay. Next one. Alright. So we have hay drillers using a perpetual system and had the following purchase transactions. Again, it's not a purchase one. So this one actually has a little bit of shipping. Now, remember who controls shipping. So, shipping point is again with the buyer. We're going to have to deal with that. I'm thinking this is what's going to happen. And then, of course, you have the selling. So, here's our transactions as we go forward. Okay. So, first one again is the purchase. And of course, we're purchasing on account because we have credit terms. 3% for 15 days. So, we have June 20th at 15. They should pay within, they are not going to pay it within. Because again, add 10, that's 30 to make it June 30th. That only gives you 5 more days, so they should have paid within July 5th. Instead, they returned before then. Okay. And this one actually tells you discount, so we should know better on that one. So again, once again, merchandise inventory, accounts payable. And this one's not requiring our explanations, so it's going to make it a little bit easier as we go forward. The only question I would have is if they want the shipping already on this one. So we're going to see. Nope. There's our shipping. So I don't think we really need this. So shipping, remember this, with shipping, it's always merchandise inventory with a purchase. And then of course, cash, because again, most shipping companies are not going to extend credit. Sorry about that, guys. It's slowly going away. Okay, next is the return. So, again, accounts payable and merchandise inventory. Because again, we no longer owe that $500. We've returned it back. And of course, we don't have our merchandise anymore. So, when it's the buyer, it's always a flip. Once you start getting used to these, it becomes a lot easier. Alright. So now we have paid. Again, we're outside the discount period. So all we do is pay off our accounts payable with our cash. And since we started with 5,300, we returned 500. We should only have 4,800 left to pay off. And of course, it's got its motivation. Fantastico. Oh, I'm sorry. So we purchased inventory of 4,300 on account from Sanders Diamonds. Terms were 1 for 10 in, and at EOM, it just says end of month. FOB destination. So again, the seller is in charge of this one. Since we're buyers on this question, we do not have to worry about that. So again, same thing we've done with purchases. Merchandise inventory is coming in. Accounts payable. Our 4,300. And again, these are not too bad. Okay. We received a $600 allowance for damaged but usable goods. So an allowance is just the same as a return. So our account payable is going to reduce, and merchandise inventory. Again, until we sell it, it's really only going to affect merchandise inventory when we get a return or have to pay for shipping or any of those. Okay. Last question. Of course, paid Sanders. So, first off, we know we have a deduction here. So we're at 3,700. We've paid within the discount period. because it was 10 days. Again, just 1%. So 3,700 times 0.01 means we have a $37 basically discount or deduction to merchandise inventory. So again, accounts payable gets paid off, merchandise inventory, then cash. So accounts payable was 3,700 because again we have to take out the allowance and basically how much do we still owe the company. Merchandise inventory is 37 bucks, and then of course we subtract 2 to get how much we paid in cash. Okay, that's really it. Okay, so now question number 3 deals with selling. So we have Antiques by Addy. Uses a perpetual inventory system. It generalizes the following sales transactions. Explanations are not required. And of course, they're going to estimate sales returns at the end of each month. So right now, we don't have any returns. So we sold 11,000 of antiques on account. Credit terms are in for 30. Notice this, we don't have a discount being offered on these. So with this one, we calculate the sale. And notice this, it's only one is to generalize the sales portion. It's going to be accounts receivable because we expect to make the money. And of course, our revenue. And since there is no discount attached, all we have to do is put the sales price. Okay. Now we have to generalize the cost of goods. Okay. So it's always a debit to cost of goods sold so that we can show our expense. And then a credit to merchandise inventory to remove the inventory off our books that has been sold. Okay. So we receive a $300 sales return for damaged goods. Cost of goods damaged is $150. Start by preparing the entry to record a sale return and decrease the receivable. Alright. So first off, we know the receivable is a credit. It is being decreased by the 300 sales. And then we have the return. Well, basically refund. So refund payable of 300. Okay, I like how they warn you on steps. There we go. Okay. Next is to prepare the entry to update merchandise inventory count. So again, dealing with the cost. So usually this is going to be estimated returns inventory. Is going to be our credit. Merchandise inventories are debit because we're getting inventory. We're going to credit our estimated returns inventory for the 150. Okay, everything good. Rock on. Okay, now we receive the payment from the customer for on the amount due. So, for us, we're going to receive cash. And since there was no discount or anything like that, we don't even have to worry. We, of course, credit accounts receivable. And since they did it within the discount period, well, there is no discount, so we don't even have to worry about the discount period. See, they start at 11,000, and they return 300. So we're really at 10,700. Check. We are good. Again, mostly if you want to do, please do T accounts. T accounts will help you out a lot in tracing these. Okay, so let's do it again. Now we have credit terms, and we also have shipping. Okay. So here we sold 5,400. So again, accounts receivable. The sell. And this is 5,400. Check. Oh yeah, this is what discount period. Oops, I was doing the gross method. This one we have to actually do discount. Just move it a little bit too fast. So. Oh, 5,400 minus 108. And really, if you're trying to find the cells, the quick way is basically take it 5,408 and times it by basically the remaining percentage that you have left. Still comes out to the same. So this should be 5,292. There we go. Oh. And there we go. So always remember for the seller to go ahead and take the discount at the time of sale. Okay? Because we're under the net method, not the gross method. Okay? Generalize the expense. Expense is still the same. So, cost of goods sold and merchandise inventory for the cost. Okay, check answer. We're still good. Go ahead and move to the next one. Okay, so we paid for shipping. And remember this for the seller. It's always delivery expense. And of course, cash. Only a 50 bucks. Remember, they already sold their product, so now everything is expense to them. Okay. Receive payment from the customer on the amount due, less the discount. Okay. So since the discount was already figured here, and they have no returns here, it really is just this amount. So again, cash with our accounts receivable, and since it's within the due date, we just go 5292. And that's it. Question number 3 is not that difficult. Again, it's just memorizing journal entries and being careful of what you do. Okay. Ooh, this one's only one journal entry. Sweet. Dave's Furniture's unadjusted merchandise inventory count at year end is 68,000. And then we do the physical count. So 66,700. Journalize the adjusted entry needed for the shrinkage. Okay. So again, we got shrinkage going on. So first off, we take our calculator and we're going to subtract the two numbers to see how much of a shrinkage we have. So 68,000 minus 66,700. Okay. We have a $1,300 shrinkage. So we already got our number. We know merchandise inventory is credited. There's the account going down. The debit is going to be cost of goods sold for shrinkage. And adjustment for inventory shrinkage for the explanation. That's really all that is to an inventory shrinkage. That one was not too bad. Okay. Okay, reading RV Center account records include the following accounts. Boom. Okay, so I'm figuring we got closing. Yep, journalize the required closing entries for renting. Record debits first. Select explanation. Start by closing revenues. So again, real quick on how revenues close out. Again, income summary. Wait. No, income summary's second. It's our revenues. So, let's see. Revenue. No. We got sales revenue and we got interest revenue. So sales revenues first, followed by interest, and then our income summary. So we have 715. Then we have 8,000. So we have to add these up to make 723,000. And this is to close out revenue. Okay, so remember, revenues always close out first, always a debit for revenues, and then we credit income summary. Next, of course, this is expenses. So here, there's a lot of expenses. At least that's what they're trying to show us. First off, it's income summary first. Then let's just find expenses. First off is cost of goods sold. Then rent expense. Building does not get closed out. Common stocks do not. No receivable does not. Accumulated depreciation, we're good. We have depreciation expense on building. Okay. So cost of goods was 371. 1, 2, 3. Rent expense was 32,000. Go. And then depreciation was 40,000. Okay. Again, we're going to add those up. And we're left with 443,000. Okay. That's really it. Again, it's just finding out which ones. And I put an amount in wrong. Oh, I read the wrong one. 16,000. Sorry. $371, 123 plus 32 plus 16. 419. There we go. Okay, so last one, well, third step, of course, is closing out income summary. And most likely, it's still a net income. So it's debit income summary and close out to retained earnings. Real easy way to see again is if this credit is bigger than this debit, then we know we need to debit income summary because it needs the most help. So let's go ahead and subtract the 2. And we need to close out 304,000. Okay, and of course put your explanation and check. Last step, always close out dividends. So let's retain earnings first, and then dividends as our credit. Let's check who we have. Dividends is 52,000. And that's really it. Oh, and of course the explanation. I always forget about those. But there we go. Alright. Ending balance and retained earnings account on December 31st. Okay, so it's asking for that. So, right here, retained earnings was started at 36,600. We're going to add what we closed out to, 304. And then we're going to subtract, of course, our dividends of 52,000. So it should be 288,600. And that's it for question number 5. Okay. Ooh, interesting. Again, preparing financial statements. Prepare Caroline's communication statement of retained earnings for the year July 31st, assuming that there was no dividends declared during the year and that business began. Okay. So right here, let's see if we can find retained earnings. Nope. And they said, again, it began on August 1st, 17. So this is 0. And all we can add in is probably net income. And they give you the income statement. Sweet. And there's our income. 4,385. This is another really easy one. So, 4,385. That one, I would say, was probably a little bit too easy. Because all you had to do is read the income statement. Okay. So, of course, we got just a little bit more. Why not? Because I didn't see how many parts right here. So, really, I don't need the income statement anymore. And all we do is begin. So, we're preparing our classified balance sheet. Begin by completing the asset section, then complete liability and equity. So again, first thing that we always put is current assets. It's always in the order of liquidity. So cash, let's see, that's not for us. Nope, nope, nope. There's accounts receivable. Yep. So accounts receivable and then merchandise inventory. So cash, 3,200. Accounts receivable was 3,300. Merchandise inventory happened to be 1,400. So total current assets, just add the 3. $7,900. Okay. Next is our plant assets, which happens to be just the equipment, and it's already netted out. So basically that just means that they've already taken out accumulated depreciation. 10,000. And then of course total plant assets of 10,000 should equal to our total assets. There it is. Of 17,900. And we're good there. Not much right there. Just remember, current assets is always by liquidity. So usually cash, accounts receivable, then our inventory. So just like that. And now we know, since this is correct, this has to be our total liabilities and stockholders' equity. Okay. So first, again, current liabilities, which of course is your accounts payable, and we have accrued liabilities. And those are the 2 liabilities we have. So accounts liability of 4,600 and accrued at 1,700. So total current $6,300. Okay. Next is of course stockholders' equity. I can find it. Oh no, long-term liabilities, my bad. Notes payable long-term, and that is 1,500. Total liabilities, add the 2 from your current and long-term. We're looking at 7,800. Next, we have our common stock and retained earnings. There we go. And total stockholders' equity. So common stock was 5,715. That should be retained earnings. Up here is 4,385. Okay. And so we'll go ahead and add those 2. And we're at 10,100. Which of course, if you already check, these do match up to the 17,900. So all we have to do is hit check and we're good to go. That took a little bit. Okay, question 7. We have the discount office systems. And they're going to have an adjusted trial balance, which we can find right here. And they want to go ahead and create a multi-step income statement. So for us, easy part, when it's income statement, it's everything below the discount. Or not discount, dividends. Hi. So this is all the accounts we have. So it looks like a lot's going on here. Not really. So first off, should be revenues, but I am figuring they're going to go net sales revenue of 239,123. Then cost of goods sold is 107,550, because it's always calculating gross profit first. Okay, it's always the first step. So 239 minus 107,550 equals 131,450. Cool. Next, it's always operating. So this would be our selling. There it is, because all we have left is selling and administrative expenses. Interest expense is going to be an other. Okay, so selling expense is 27,700. Administrative is 14,400. We're going to add those together to get our total operating expenses. So we have total operating expenses of 42,100. Okay. So this will be our operating income. And we're going to subtract these two now. So 131,450 minus 42,100. We're now at 89,350 of income. Okay. Next is our other income and expenses. And watch out, expenses are going to be negative. Okay, they're going to actually be in parentheses if you want to, or you can put a negative sign. So there's our interest, negative 2,500. Then of course total, and our total is only the negative 2,500. Or again, I'll show you it in parentheses. So that way you can see that you can use both ways. And we subtract out now 2,500. So we're left with 86,850. Okay. And that's really it for that one. Okay. So, next, Browning Bakery earned net sales revenue of 62 million in 2018. Cost of goods sold was 40,920,000, and net income reached was 7,000. So forth. So, company's highest ever. Compute the company's gross profit percentage for 2018. Okay. So, gross profit divided by net sales revenue. Again, I'm going to go ahead and waste the check answer. The only reason why is to make sure that the formula's okay. Again, you got 3 of those. But always you want to check to make sure your formula's right. And so, it really is gross profit divided by net sales. Now watch out on this one, because it gives you net income, but not gross profit. We have to figure that out. So we're going to take 62,123 minus $4,920 million. And we get gross profit was $210,800,000 or 80,000. Yeah, 21,080,000. Yeah. I'll make sure I got that. 21,080. Good. And we divide by our net sales. Okay. So here, so we find out that again it is only 34%. So remember, you have to convert the decimal to percentage. Okay, check, and we're good to go. So last question. Again, not too terribly bad. First off is the inventory shrinkage, which we already know is cost of goods sold and merchandise inventory. So unadjusted merchandise inventory was 5,000. Cost associated with the physical account on hand was 4,450. And then in addition, estimated approximately 900 merchandise sold will be returned. So we're not worried about that. That's part 2. And this is just part 1. So we gotta find the difference between 5,000 and 4,450. 550, not too bad, because that's the inventory shrinkage. Okay, now we need to journalize the estimated refunds. Okay, this is where we start up our payable. Okay, so first off, sales revenue, and where's that? There it is. Refunds payable of 900. Because they've already figured out the approximate. We don't have to figure that out. So there's the refund. Okay. Second part is doing the inventory. So instead of cost of goods sold, since we're doing an estimate on the returns, it's estimated returns inventory and merchandise inventory in itself of 300. Check. Oh, my bad. Cost of goods sold. So, estimated returns inventory and cost of goods sold. And there we go, guys. That's it for your estimate. Okay, and that's it for homework for Chapter 5. So if you have any questions, please let me know, and I will answer them as quickly as possible.